The chances of a deeper correction are fading. Interest rates have stopped going up, and the amount of stocks trading higher is starting to accelerate. In last week's analysis, we covered why January 15th would be the turning point for markets if inflation surprised to the downside. And that's exactly what we saw.
We got some really important news. So the CPI came in cold. This is what we were expecting.
CPI was dovish, and actually I think some of the inflation prints the last 2 days have been dovish, including PPI.
Shelter disinflation leading the charge. So that kind of calmed yields down, allowed equities to find their footing.
So it's setting the stage for yields to kind of cool.
Yields are long-term interest rates. As they cool, expectations for earnings growth can rise.
And at a time when sentiment's been negative, I think we should be rallying.
Core CPI minus food and energy came in lower than expected, which reduced the future expectations of inflation. This is a huge macro shift. The bond market can adjust interest rates lower, and the Fed can pull in rate cuts closer. This was a huge positive surprise, and keep in mind, surprises move markets.
The market was bracing for a really hot number. There was a 30% plus chance of a Fed hike. Those sort of extreme views have been quelled.
It's kind of ridiculous to watch. I mean, you had people screaming for emergency rate cuts back in the summer and now saying we don't think we're going to have any cuts from here and the Fed's probably done. Maybe the next move is a hike.
The inflation print over the next 3 months is going to be a lot lower than what we saw November and October. And remember, January to March of last year, it was close to 0.4. So I think inflation is setting up for some good comps.
Okay.
We're not going to 8% mortgage rates. The Fed is not considering hiking. The economy is not that great, like relative to last year. It's definitely not better.
There is no chance of a rate hike. This week's retail sales came in weaker than expected, along with jobless claims showing weaker employment. Macro is telling us the economy is strong, but not even close to overheating. And when we put it all together, this week's macro report sent the dollar and interest rates lower, which made financial conditions easier for markets to navigate. Easier financial conditions lead to more risk-taking. But the good news doesn't stop there. We also got some reassurance about the fiscal deficit.
We have a spending problem. For the past 40 or 50 years, federal government revenues have averaged about 17 to 17.5% of GDP. And spending has been slightly over that, leading us to a 3.5% budget deficit.
Now, the expectation of government overspending drives interest rates higher, but the new Treasury Secretary, Scott Bessent, eased the market's fears by simply addressing the problem.
This spending is out of control. We have never seen this before when it is not a recession or not a war.
But wait, the good news doesn't stop there. Oil prices are also starting to cool, which may have or may have nothing to do with peace in the Middle East.
Breaking news on this Sunday morning as